Thank you, everyone, for joining us. This is Everything is a Fraction. My name is Jordan Pandy. I'm a reporter at Insider.
My name is Brian Daly, co-founder and CEO of Groundfloor. We invented the first fractionalized product that allows people to participate in real estate investment loans back in 2014. We qualified that product with the Securities Exchange Commission in 2015, and since we've sold $895 million worth of securities to individual investors, non-accredited and accredited just like you, over those 8 years.
All right, so I'll start it off with my first question. When I mention fractional investing and fractional real estate to other people, it clicks almost instantly, and they say like, oh, this actually makes a lot of sense.
Yeah, I think the truth is, I mean, we all have to realize this as issuers up here. We sell a product that no one has heard of in a category no one has heard of from companies that investors haven't heard of. And it takes a while for the regulatory change to happen. My co-founder worked on Title III of the 2012 Jobs Act. That's the equity crowdfunding part of that legislation in Title III. And it took the SEC 3 or 4 years to promulgate the rules following that legislation. So that's 2012 to 2016. We raised our Series A in 2015. It took us 2 more years to receive qualification nationwide. So when you're talking about, in a way, it's similar to prop tech. Fintech is an old industry, invest tech is an old industry. It requires regulatory change to happen, and that set the table, certainly for Arrived and for Groundfloor, which are 2 issuers who use the regulatory construct, right, that was put forth in Regulation A. After that, crypto happened, Robinhood and GameStop happened. The retail investor woke up, and we think the retail investor is a sleeping giant that is poised to change a lot of capital markets. And when you think about real estate, I mean, that should be the first and best one. 67% of Americans own a single-family home. And so if you're talking about participating in a rental property or participating in a real estate investment loan on our platform, that asset class is familiar to people. So I think everyone's felt the downside of investing in YOLO stocks and cryptos, and now they're trying to figure out what's next. What's safer, what's more stable, but yet still delivers very attractive returns from rentals or from investment property. I think that's what's actually happened over the last 8 years that we've been doing this, and we feel like now the market is really starting to blossom as the retail investor wakes up and takes action.
For this next question, it's sort of like a chicken and an egg situation. Brian, you sort of just spoke about the retail investor waking up. And I'll start with you, Brian. Was it first the investors are waking up and realizing that fractional real estate is something that they could get into? Or did fractional real estate happen and sort of persuaded investors to get into it?
Well, it's a fair question you're asking, right? It's, where was this really driven? Where was the innovation driven? Was it driven because customers were asking for it? I don't think so, frankly. I think it has taken some coaxing over time to show investors that this is real. It's not a Ponzi scheme. It's not a scam. We've delivered 10% annual returns since inception. And in our model, because we're making short-term real estate investment loans, that capital is returned every 9 to 10 months. And once people start to experience that, they wake up to it and they realize, hey, wait a minute, this fills a huge white space in my portfolio. What we did is we looked at what hedge funds do and what large institutional investors of all sorts do. And we said, what if you made it possible to build as diversified a portfolio so that the returns become more predictable, right? If you have more assets in a portfolio of a certain type, you can predict the return within a more narrow range. And empirically, that's been true for us over 3,000 properties that we've financed over the last 8 years. And when that starts to happen, people start to experience it and believe, and they start to realize that it really is possible to invest like a family office or a hedge fund or a large institutional investor. You can do the same sort of investing on the same terms and make the same types of returns without incurring a lot of risk. And what we said when we launched the company was, everybody thinks the problem is that you're not getting your fair share of the pie. The bigger, more insidious problem that we're all serving is that you're really not getting served the same thing. They're giving you cake, calling it pie, and laughing as we all sit there investing in funds, public market secondary trading where we're the sucker at the poker table. And that's what's great about fractionalization. So what's happened is people have participated in this and they've gotten over the Groucho Marx problem. The Groucho Marx problem is, I wouldn't want to be part of any investment that would have me, right? And we've shown that this is an investment that you can access, that is good for your portfolio, and that you can benefit from without being defrauded. And I just think it takes time when it comes to people's money to realize that that's possible. So, Arrived is showing that. You guys are starting to show that with your launch this year. There are dozens of companies in real estate and beyond that are showing retail investors that there's something better for them and that they can have a slice of the real pie that institutional investors have been getting. And I think that's been the big change, is it's leading by doing.
I want to switch gears a little bit and talk about some of the benefits of each of your companies. Something we've talked about previously is sort of the democratization of retail investing and real estate investing.
One of the reasons that we established a $10 minimum to invest was not to induce trial. You could have a higher minimum and induce trial. What we wanted people to do was invest like a hedge fund would or like a private equity fund would, and to diversify. So the average investor on our platform puts, like Ryan was saying, puts a lot of money to work, a couple $1,000s in their first 30 days on average, but they own 100 loans. And the lie that the investment community tells you, or that the investment industry tells you, is that in order to get that kind of diversification, that you have to entrust your money to a fund manager and pay for the privilege, and then be locked up from redeeming your shares when you most need the money, right? During COVID, some pretty famous E-REITs out there on the market stopped redemptions. I know because I was an investor in a couple of them, and when I tried to redeem, one of them took 2 years to give back my capital. I just think that's an outmoded way of investing, and fractionalization opens that up because it gives us control. It lets us retain our agency as investors, and that's empowering for people, and I think it's also good for them financially. But here's the point that you asked about that I didn't expect. We theorized when we started this that a capital market that was composed like the web itself, like the internet itself, right, with millions of nodes instead of a few nodes that were too big to fail, we theorized that that capital market would supply capital to the users of capital, the entrepreneurs out there, on terms that were better for them. That was a theory when we started, but 3,000 properties that we funded later, 3,000 of them, we now know that the features that we are able to offer to the user of the capital, the person that's renovating housing stock or building new supply, we are enabling them to invest on better terms than they can get from institutionally fed lenders or capital providers. It's a huge surprise to us. It's one reason that the people who borrow from us pay on average 50 to 100% more willingly in terms of fees to access that product. And that's emblematic of the value that we're creating in the built environment. There are houses being renovated by independent developers that probably wouldn't have been renovated without this capital. There are houses that are being built by independent developers, not huge production builders, in areas that might not have been built in the same way. And we are financing a wave of product development in ADUs, in other affordability-driven sort of product that I don't think would exist at scale without this method of financing the build and the acquisition of those properties. So, we're still exploring it. We're a platform. It's early days. I think there are decades to go before we see the full impact that this will have. But in the early innings, I count myself really proud to be building a platform like Ryan is that's having that kind of impact, in the built world.
So I hear a lot of you talking about sort of, I guess, the little guy and people who may not have had the opportunities to invest before and allowing them to diversify their portfolios. And something that I know a lot of you do is you have a low barrier of entry. Like, for example, Arrived, you can start at $100. So was that sort of, how important was that to the psyche of your company when starting out, saying, hey, I know that there's people who want to do this, and we're going to make it a lot easier for them to do that?
Yeah, I mean, I would just say one of the most controversial decisions I made as CEO in the early days, and my angel investors, really pulled me aside and said, are you sure? Is when we chopped our minimum down to $10. Their fear was that you could never finance anything with $10. But we were purposeful about that, and we've proven now, we frequently will put 800 to 1,200 investors in a loan that's, a couple $100,000. If you do the math on that, the average comes out to a couple $100. Some people are investing $1,000 at a time. Some people are investing $10 at a time. The point is that you retain your agency to make those decisions, and that's what you were saying, right? You retain your agency to decide what risk you want to take and how much money you want to put into any one property. And I think if I told you that you could invest in the stock market, but you had to invest in my fund, right? You look at me like I had two heads. You say, no, I want to buy Tesla. I want to buy, Google. I want to buy some of these stocks that I know. Well, we can't let people, when it comes to private markets, be held hostage to fund managers. That's an outmoded way of investing. And I think getting down to that $10 makes every one of us, or getting down to $100 as well, makes every one of us our own fund manager. And I think that's the future. That's what people want.
For a lot of people, fractional investing seems like a new product. And Brian, I know you've been at it for a while, but what does the future look like? Do you think that this could become a normal way for people to invest in a lot of things, Andy?
Look, I think when it comes to real estate investing, we're broadening the market for it. I mean, there is, as Ryan has said, there's latent demand to invest, especially in single-family residential real estate. People just don't know how to do it yet. And it's up to the startups, like Arrived and Groundfloor and half a dozen others, right, that are, working on these problems to make this a mass consumer experience that is as good in what we do, right, providing primary capital in a private market, as Robinhood was at allowing stock trading, right, at scale. Now, we can all argue whether a stock trading app that gives you confetti when you make your trade is a good thing for the investor or society or not. I think we're all making products that are, fundamentally good, for people, and they know that at their core. They know that this asset class is good for them, but we also have to create consumer experiences that are low friction, that build confidence, that educate, and that demonstrate value. I mean, one of the reasons we picked short-term real estate investment loans is because they return capital every 9 to 10 months. And because that's true, people get a return quickly, sometimes as few as 3 months, right? If you invest in 100 or 200 ground floor loans, you're going to soon be receiving not only interest, but principal and interest at about month 2, because some of those loans pay back really fast. And what that creates for people is cash flow. And we need to build experiences. One of the platforms that I like that's outside of real estate is called Vint. Vint is a place where you can buy a fraction of a collection of wine or whiskey. One of the things I really appreciate about them is they will frequently sell a collection, right? And they'll allow people to realize their gains and put that in their pocket so that, in our case, we see a huge rate of reinvestment, right? We see the product is very, very sticky because of that. And we all have to design experiences of investing. We provide, for example, we provide updates on your loans every 30 days, right? We do that to build confidence so that you see what's happening with the property. I love the emails that I get from Arrived because I'm an investor on Arrived. I love the updates that I get, right? It builds confidence. And equally, when the product pays off, we got to put that money in the consumer's pocket and trust that they're going to have choose to invest again. And that's been happening for us for 7-8 years now. I know it's going to happen for you, Ryan. I'm sure once you get launched at scale, it'll happen for you because these are fundamentally good products for people. And now we just have to build good experiences around them.
Thank you.